Hi, everybody. April 11th, the market update desk with Scott Riley, NMLS number 157524. It has been a whirlwind of a week and a quarter here in the market, keeping on top of us. In the last, 30 plus years I've been in the mortgage business. It's one of the top four that I can remember for volatility and tough to pin down for the week. I worked through the dot-com bust, worked through the housing debacle, worked through COVID, and now we get this tariff, inflation, job creation, media-driven cycle. So let's review what's gone on the last day and a half, bring you up to speed, give you information on what to expect. So on Thursday, President Trump dropped tariffs unexpectedly on all countries but China. He dropped it to 10%, at least for the next 90 days. This caused a huge rally in the stock market, brought back from the negative. Um, Now, there have been a lot of rumors as to why the bond market has been performing the way it has. And let's kind of go through that. One of the reasons the sharp declines in the stock market caused margin calls. And when that occurs, investors must sell liquid assets. Oftentimes, they have to sell their treasuries as they are highly liquid. Now, another reason is the unwinding basis trade or bond basis trade. Now, on social media, some are saying that bonds are selling off because China is selling their US bonds. Um, that's really not something that's accurate when you look at the facts. First off, China is no longer even close to the number one holder of US Treasuries. Actually, the Federal Reserve is the leader at 4.7 trillion. We have Japan at 1.1 trillion. Now, and then we have China at three-quarters of a trillion, and then the UK at just a tick under 0.74 trillion. So if China sold treasuries, it would be a huge loss because they purchase most of them at much lower yields. If they're selling their currency would also strengthen, but it's been doing the converse. It's been weakening. China has also, in the past, tried to keep their currency weak versus the dollar when the US buys goods from China. China gets US dollars, which would normally strengthen their currency when exchanged for the yuan, especially because they export so much more than they import. They also don't want this because it would take their exports to become more expensive. China then repatriates their yuan into dollars by purchasing US equities and treasuries, keeping their currency from rising. Part of the international issue with China is the currency manipulation, and this has to do with that to an extent. So, now, the other thing we talked about was the basis trade. Investors and hedge funds are always looking for arbitrage, the differential or profit margin, or inefficiencies in the market, which is essentially a mispricing between the two assets and almost guaranteeing profit. In this case, it involves buying treasuries in the spot market or cash market, which is essentially a mispricing between, I'm sorry, and then selling the futures and contracts of the Treasury if there is an arbitrage opportunity or profit opportunity. I've got a lot of notes here to go through that I've been taking. The inefficiency or mispricing in the market is normally small, but can be made much bigger by using leverage. And many of the hedge funds are leveraging 50 times or even 100 times, which makes the gain or loss significantly larger. It's multiplied. When using leverage, you're borrowing a large amount of money so that there's not a lot of cushion. If the trade goes the wrong direction, once you're liquidated, you have to sell the underlying asset or treasury to cover that call margin. So, for one example, if an investor used 100 times leverage on a $100,000 investment, they'd be getting a purchase power of $10 million. That means a very small move in the market in the correct direction for that trade can cause very large profits. But conversely, a move in the wrong direction can cause very substantial losses and require liquidations very quickly. This basis trade is not small. It makes up nearly $1 trillion of the roughly 3% or roughly 3% of the entire 29 trillion US Treasury market. So let's look at one example here. A 10-year Treasury basis trade involves buying and selling the 10-year Treasury futures contract or going short. Assume the 10-year Treasury bond is trading at $98 and the 10-year Treasury future contract is trading at $99. There's clearly an arbitrage opportunity as the future contract, once it nears expiration, should cover the price of the Treasury. It appears to be priced too high. The investor would buy the Treasury at 98, sell the future contract at 99. As the futures contract nears expiration, the price should converge, and the futures contract price falls to $98. The investor can then buy back the future contract, and they sold short at $98, locking in a profit of $1 a contract. Keep in mind on $100 million of leverage. But if the bond market moves too quickly, which it has been, instead of the price of the Treasury and futures contract converging, they can go in opposite direction, causing large losses and liquidation requirements. Last week, stocks fell sharply on news of reciprocal tariffs. As you would expect, Treasury yields moved much slower and fast. The 10-year moved sharply lower from 4.3 to 3.86, but the futures contract that they were holding short of equal value did not move as quickly. Instead of the price of the Treasury futures contract converging, where they make money, they widened and they were put in losses, and they had to put in losses and needed to liquidate. That forced them to borrow. That forced them to sell borrowed treasuries at up to 100 times leverage, and that's why the stocks continued to move lower. You didn't see the benefit in the bond market. Yields moved higher as a lot of this trade was unwound and treasuries were sold, causing yields to move sharply higher. So it's been a wild ride. The other thing we saw on Thursday was CPI, Consumer Price Index, came in lower than expected at 1/10 for the month, lower than the increase. I'm sorry, negative 1/10, as opposed to the expected up 1/10. Year over year, lowered from 2.8 to 2.4%, a tenth lower than expected. Core rate increased by 1/10, which was 1/10 lighter than the market called for. And the year over year moved from 3.1 to 2.8, also better than expected. Now, one of the things that helped out was airline fares fell sharply by 5.3% due to combined lower fuel cost from lower oil, which we're seeing, and less demand. Shelter costs, which is the most important component within CPI, as it makes up 44% of the totality, that came in at a favorable 0.22, but not exactly for the right reasons. Rents rose 0.33%, while owners' equivalent rent rose 0.4. But the volatile lodging away from home fell 3.5%. And that dragged down the overall shelter component. Used cars and trucks fell 0.7. Motor vehicle insurance finally again dropped 0.8. So shelter was really the main reason why we had a higher CPI. Today, we're seeing mortgage bonds are moving, mortgage-backed securities are moving sharply lower yet again. And the latest in the trade war saga is China increased reciprocal tariffs from 84 to 125%. But it's really just optics at this point. Once the tariffs are above 50% on our goods, it doesn't make sense to buy anything from us anyway. The turbulence in the market and economy is causing many thought leaders to believe that we're already in a recession. We've talked about it before. Larry Fink, CEO of BlackRock, John Muldoon, very notoried economist, Lacey Hunt, another economist, all believe that we're either in a recession now or we're very soon going to be. If we do see a recession, if we do see more recessionary signs, it could lead to the Fed stepping in and cutting rates, which who knows, maybe that's what the administration's really trying to push right now. Credit card data from Q4 last year from the Fed Reserve Bank of Philly showed that consumers were already feeling the pinch and are in bad shape. The share of active credit cards in the US that only make minimum payments rose to 11.1%, highest level in 12 years. Additionally, the share of accounts 90 days delinquent or more also rose to a series high. So, producer price index that came out today showed that the March report, that headline PPI, came in at a negative 0.4%, as opposed to the street estimate of an increase of 0.2. That brought the year over year PPI from 3.2 all the way down to 2.7. Estimates were looking for it to actually raise to 3.3. So this was a 6/10 better net than expected. Core rate, which strips out the volatile food and energy, was reported at a negative 1/10, which was much cooler than the increase the market expected at up 3/10. Year over year core CPI fell from 3.5 to 3.3. The bond market really didn't react to it. It said, ho hum. It's watching the carry trade, the bonds, and tariff situation in reaction more so than the inflation data. But a lot of this data flows into the PCE report later this month that the market will definitely pay attention to. So next week, a little bit of slower data week as I'm seeing. We got mortgage applications, retail sales, 20-year bond auction, and housing market index. Then on Thursday, we get jobless claims and housing starts permits. 10-year bonds looking ugly right now, jumped all the way to 4.531. The next level of resistance is barely above where we are at 4.588. Hold on tight. Hopefully next week we get a little calmness. Give us a call. Hopefully this brings you great information and increases your knowledge base, helps you make great financial decisions. The Market Update Desk, 616-293-2189. Have a great weekend.